Good morning, everybody. Good afternoon, good evening, wherever you're from. Please let us know below in the comments. If you're back to my channel visiting again, thank you. If you're a subscriber, thank you. So this is a wealth building channel, so I hit a lot of different things, and I haven't hit investing yet. So we're going to go over a little bit of investing and just hit it a little bit. I'm not going to go too in depth on this video. This is just for beginners. Some of the things we'll be talking about here are mutual funds, index funds, exchange traded funds, bonds, and CDs. They're saying that it is best to start with simple investments as mutual funds, index funds, and ETFs before moving on to complex investments. Some of the types of investments that we have here are stocks, bonds, mutual funds, index funds, and ETFs, CDs. We have real estate, annuities, options and futures, cryptocurrency, fine arts, and other collectibles. My current investments are mostly real estate because I can actually see what's going on with them. And I rarely ever lose with that either. They're usually going up. Now I do have a little bit of stock where I work in my job that helps with retirement. So let's see your stocks. So with stocks, if the company's outlook is good, the investors will be willing to pay more for your shares than originally paid. So this is the good thing about stocks. Your shares can increase in value, but the bad thing about stocks is they can decrease in value. They can be impacted by factors inside the company, like strong quarterly profits or poor revenue, and political turmoil. You got war going on. We got a lot of drama in the last few years with COVID. So all these things can affect your stocks as we know. As you can tell, I'm going very basic here, so I'm just going to go over some of the differences. In case I expand on this, I won't lose anybody. Now, if an investor is watching this, they're probably laughing because it's so elementary, but that's okay. All right, setting, when and where. All right, let's see. Diversification is a strategy used to manage risk. So what this is saying is have your money in different types of investment, right? Which is the same I always preach about jobs. You should always have more than one job going on at the same time in case you lose it. Got a backup. I rarely ever live my life with just one job. I just don't trust people enough to put my life in their hands and end up on the street. So this is the same way with investments. You know, have more than one. Have it in don't put your eggs all in the same basket. If you ever hear that statement, that's what that means. Do not put all your money in one thing. Okay, let's see what this says. I wrote this up a long time ago, so I can't remember here. Okay, investing in treasuries and municipal bonds. Okay, now we're talking about bonds. We have corporate bonds and government bonds. You don't have to pay federal income tax on the interest from the municipal bonds and the interest you earn on treasuries. Okay, so that could be a plus on corporate bonds. Government bonds are apparently more safe, but I don't think you really make a lot of money on these. These are, and if you listen to Dave Ramsey, he's very much against bonds. Lower risk and tax advantages are two reasons they shift their allocation towards bonds. Bonds are a safe choice. They are a safe choice, but you really don't make a lot of money from them. So that it's your choice. It's a safe choice. If you don't have much time to I can't even speak. What's the deal here? Bounce back from market losses. So if you're not willing to wait for the stocks, try the bonds. All right, let's see here. Mutual funds. Mutual funds are a collection of stocks and sometimes bonds, and they are essentially buying small pieces of different assets with single share purchases. We're going to have another video going more in depth on this, but this is just a basic overall thing. Typically, a mutual fund is designed and managed by financial professionals. Some mutual funds are index funds, which means they make up their performance tied to the market index, such as the S&P and the Dow Jones. Minimum investment can range from $500 to $3,000, though some offer a minimum as much as $100. So just be on the lookout for that. And you need to do your research. And you need to do your research on whatever you want to invest in and make sure it's just not fraud. Like the same thing with the crypto. ETFs. And both of the index funds and exchange traded funds are similar to mutual funds, except they have a different investment assets. One of the key differences is they aren't actively managed by live human beings. So if you don't want somebody managing your money, you might want to do an index fund. We'll go more into depth on this in another video. I just wanted to hit this. The only big difference between the two is how they're traded. You can buy and sell an ETF. Did I say that right? ETF? Yes. Throughout the day, while you can only trade an index fund at the price point at the end of the day. We'll explain this more a little bit later. Many ETFs seek to replicate the performance of overall stock market or major stock index, and others aim to represent a smaller segment of the market. So these are some of the difference, and I'll explain more of this later on. I don't want to confuse anybody. That was kind of confusing right there. Okay, CDs, I'm not really too sure. A lot of people don't even do these anymore. They're among the lowest risk investment, but you're probably also not going to make a lot of money. They have a fixed term length and a maturity date. It's kind of like putting your money in a savings account. They aren't a good option for growth, but they're a good way to earn interest safety. So yeah, it's kind of like just like a savings account. All right, you need a lot of money. Some investing apps should begin as low as $1. Now, like I said before, you need to research whatever you're investing your money in to make sure it's not fraud, because there's a lot of that on the internet. Starting small is always better than not starting at all. And if you can step up your 401, that's good. Now, if you're doing the Dave Ramsey plan, we don't do this until like step 3 or 4. You got to have all your bills paid off first. And before we start investing, we made sure we have all our debt cleared out. Now, if you still have a mortgage, you can put some money in your retirement, but it's not necessary until you get your debt paid off. And I try to listen to multimillionaires and billionaires. That's a great wealth building strategy, to listen to what they're doing and try and replicate it. The best place to start investing depends on your financial goals, as well as how much money you can afford to invest. But if you don't have a few $1,000s laying around, don't worry. There's plenty of other avenues to get in the market. So it's like the turtle and the hare thing, okay? I consider myself a millionaire as well, but this is not a fast thing. It's like the turtle and the hare thing. There are some people that get blessed, and they're in entertainment, and they get all this money real young, but I mean, I'm not one of them. I've had to work my way up, and I consider myself a little older and wiser, and kind of like the turtle. Matter of fact, when I was in the military, that's what they called me. They used to joke about me and call me the turtle. So that's a good thing, because the turtle won. Between the turtle and the hare, I always keep that book around. The turtle won. So, be a turtle. Take your time. Get your bills paid off. And make it happen. You listen to other people that make a lot of money and how they do it. And you are going to make mistakes, because I made a lot of mistakes, okay? We all make mistakes. Because we're living, right? Anyway, this is just a short little video on basically breaking these down a little bit and what to invest of. My suggestion is not to do this unless you are doing unless you want a savings account. This is really a savings account. At least have $1,000 in your savings account. 2 would be even better. And then start paying off your debt, and then we start our investing. Okay, that's the way we should do it. Get rid of the debt first, and then you'll have more money for your investing. Okay, that is my video for this time. We're going to expand on this a little more as we go on, because I know this was very basic, and hopefully I didn't confuse all my beginners. All right, everybody. See you on the next video.